Hello, welcome to today's class. Our topic for today is property, plants and equipment, IS 16, a very fundamental standard, practically unavoidable. So you want to listen carefully and learn everything that has to do with IS 16. All right, so we start with the introduction, of which is the definition. So we'll start with what an asset is. All right. So an asset, as we discussed in our previous class under the conceptual framework, we said an asset is a present economic resource controlled by the entity as a result of past events. All right. So when we say an asset is an economic resource, what we mean is that the asset has the potential of bringing forth economic benefit. Because for it to fulfill the definition of an asset, it has to fulfill the fact that it is a present economic resource. It has to be controlled by the entity as a result of past events. So if you're going to, if the economic resource would qualify, that is, if the asset would have the feature of an economic resource, what we mean is that that asset has the potential of bringing forth cash inflow. All right. Or it could be that it has the potential of reducing the cash outflow, of the organization. So it's not all the time it has to bring in money, but sometimes it could also be that it's helping to reduce costs. So once we see those either or both of these, then we know then it is an economic resource. Another thing is that it is used in production or service delivery. So remember when we talked about, I think IS2, yes, inventory. We said inventory is an asset that is held for sale, whereas property, plant and equipment are assets that are held for use. So what you want to be able to remember is that it's held for use in the production or in service delivery. An asset is also an exchange for other resources. All right. So sometimes it could be an exchange for other resources. All right. So your property, plant, and equipment represent your tangible asset. So we're going to be learning all the types of assets, the intangible asset. Or your PPE represents the tangible asset. So, like we said, they are held for use, for production, for supply of goods or service. They're held for rentals, or they're held for administrative purpose, and they're expected to be used more than one period. So one period means 1 year, right? So we expect to use them beyond a year. Hence the reason why they qualify as non-current assets. All right. So tangible assets, of course, are assets that have physical substance to them. All right. So you have your land, your plants, your building, your motor vehicle. They are all tangible assets. While your intangible assets are those without physical substance. So this would include your patent rights, your IP, your goodwill, your maybe franchise and all of that. All of these things makes up your intangible asset. But we're going to be focusing on just PPE in today's class. So we're going to be looking at some definitions that's going to help us glide through this entire standard. So the first definition is ability to know what it means to say the cost of an asset. What does it mean? Because sometimes people don't even know clearly what's to be used to determine the cost of an asset. And if it's going to be recognized in the books, it has to be measured, right? And that means it has to be reliably measured, and then the cost has to be known. So the cost of PPE is the amount that can either be one of cash or cash equivalent paid, right? So it could be cash paid for it, it could be an equivalent of cash paid for it, or it could be the fair value of the other consideration given. So it could be that we give up something to purchase this asset. So the fair value of what we gave up can also be represented as the cost of the asset. Going forward in this class, you'll see examples how an organization would give up an asset to acquire another asset. So even as much as they've acquired another asset, the cost of the asset acquired is actually the fair value of the asset that was given up. We're going to be learning that. All right. So the next one is that it could be to acquire an asset at the time of its acquisition or construction. Now, why it's important to note that sometimes an item of property, plant, and equipment may not necessarily be purchased by acquisition. It could be by construction, right? So if you're going to be building a property and it might last 5 years, 10 years, right? To build that property, right? We'll say that is an asset in construction, all right? So it could be also for such. So when you remember the cost, you're saying, is it cash? Is it cash equivalent? Is it a fair value of the consideration that was given up, to purchase this asset or to get this asset? Or is it as a result of an acquisition or as a result of a construction? So all of these things would help you understand the cost of an asset. The cost of this course, you would then have to learn that aside the cost of an asset, we then have to do with other terms. And the next one is the fair value of the asset. Now, the fair value of an asset is the price that would be received. It is important you remember that it's what will be received, not what you will pay. So if I want to know the fair value of an item of PPE, it is what I will receive. Remember, the PPE is with me already. The PPE is with me in the organization, right? But if I want to know the fair value of that property, plant, and equipment with me, I then have to check what I would receive if I were to sell, the PPE with me. All right. So a fair value of an asset is what will be received to sell an asset or what will be paid to transfer a liability. So if it's a liability that is going to be transferred, it's going to be what I'll be paying. If it's an asset, it's to be what I'll be receiving. All right. So don't mix it up. In an orderly transaction, orderly, that means in a very orderly transaction, no information asymmetry, the buyers and the sellers are clearly identified between market participants, and the market participants, of course, are the buyers and the seller, and then, of course, the measurement date. The measurement date speaks to a period, right? So it's not because the fair value of an asset can change over a period. It can even change in the space of 1 year. You could have like changes in the price, in the fair value of an asset. So that's why the measurement date is important. We need to know what date was the fair value determined. And that's why we said it is the amount or price that will be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. The next is depreciation. All right, so depreciation is not what we used to learn. I know most times in some places you will learn, oh, depreciation is wear and tear, da da da. No, that's good for the layman, but for you as an accountant, depreciation is a systematic. Systematic means there's a process to something, right? It is a systematic allocation. That means what are we allocating? The depreciable amount of an asset over its useful life. So when we say we're depreciating an asset, we say we know the depreciable amount of that asset and we're allocating it over its useful life. So if it's 1 year, 2 years, 3 years, 4 years, 5 years, we're allocating the depreciable amount over the useful life of the asset. So the next question is, what is the depreciable amount? Now, the depreciable amount is the cost of an asset less its residual value. Simple. Cost less residual value is depreciable amount. All right. So these other ones is just to properly define what cost is. Cost of an asset or other amount substituted for cost less its residual value. So always remember, depreciable amount is cost minus residual value. All right. So what is residual value? What is residual value? Now your residual value, from the name residue, all right, can also be called scrap value. The residue is what is left, right? When you say something is residual, is a residue, is the estimated amount that an entity would currently obtain from disposal of the asset. All right, so if we were to sell these assets, right, maybe after the useful life of the asset, this is what we technically will have to obtain from the asset. So we want to have that idea even at the beginning, even though we haven't sold the asset, because it means that this asset at the end of its useful life can still bring in some form of income, because when it's sold, it means that somebody's going to be paying for that asset. All right. Okay. After deducting the estimated cost of disposal, so of course you determine the cost of the disposal, you take it out of the disposal proceed received if the asset were already at the age and the condition expected at the end of the useful life. So residual value is saying the value of the asset if we were to sell the asset at the end of its useful life. That is the residual value of an asset. Impairment loss. I know we're going to be treating an entire topic on impairment, but for now, we need to understand that concept. Impairment loss says it basically says that the carrying amount of an asset, whenever the carrying amount of an asset exceeds its recoverable amount, then we say that asset has impaired. Now, what does that mean? In your books, you carry an asset at its carrying amount, and you remember your carrying amount is your cost of an asset minus depreciation, right? So you keep carrying the asset at that price. That's the carrying amount. So now in your books, you are carrying an asset for 500,000. But by the time you check the recoverable amount, and the recoverable amount is actually there are two things that determines your recoverable amount. So you have your value in use and you have your fair value less cost to sale. So you pick the higher one. So your recoverable amount says check the value in use. Value in use talks about the future cash flows that will be generated from that asset. So you want to discount the present value of that future cash flow. That's a value in use. So literally, what it means is if I will continue to use this asset, what is the value of this asset to me? And of course, the value of the asset to me will be what the asset will be bringing in into me, right? So that's the value in use. Then we have the fair value less cost to sale. Now, the fair value, like we said, is that amount that you would be receiving if you were to sell an asset or to transfer a liability. So in this case, it's an asset. So if we were to sell this item of PPE, this is what we'll be receiving. So you can see both of them is that they kind of make sense. Okay, what should be the recoverable value of an asset? Okay, it should be a comparison between, well, if I were to sell the asset or if I were to continue to use the asset. All right, so if I were to sell the asset, this is what the asset will bring in. That's the fair value. If I were to continue to use the asset, this is what the asset will bring in. That is the value used. So I pick the higher one, then I take that and then compare that with the carrying amount of the asset. So if the recoverable amount, depending on whichever one is higher, then becomes 300,000. And in your books, you're carrying that asset for 500,000. Now, if the recoverable amount is 300,000, it means that 300,000 signifies the worth of the asset. And then your books, you're carrying out that amount, at least you continue to record in your books at a price that is higher than the recoverable amount. It's not so right? Because like you're putting something in your books more than the value. The value it is in your books is not what it is in the real life, in reality. So we will not watch it as accountants. So we say, oh, when that happens, we need to impair this asset. All right, impair means I have to write off this loss on this asset. There's an impairment loss already because I need to make sure this 300 here equals to the 300 here. All right, so that means for 300 to be equal to 300, that means I have to recognize an impairment loss of 200,000. So we're going to learn that more in our impairment of assets. But for now, we need this basic understanding. So that's it about the carrying amount and the impairment, loss. Now let's talk about the recoverable amount. So I've explained that already. It is the higher of an asset fair value less cost of sale or its value in use. Any one that is higher becomes the recoverable amount. Now, what is the useful life of an asset? Now, the useful life of an asset is an estimated period of time that we hope to obtain benefit from the asset. Is a period over which an asset is likely to be available for use by an entity or number of production or similar units expected to be obtained from the asset by an entity. So if it's like number of years, how long useful life says how many years do we need to be able to obtain benefit from the asset? All right. So If it's in units, it means like just like your printer, right? So if you use like your cartridge in your printer, the cartridge in your printer, if it were to be seen as an item of property, plant and equipment, right? It's an equipment. If it were to be independently seen, you'll notice that the cartridge has like a specific number of pages it can print, right? For it has like specific pages. So if it says this cartridge can only print 20,000 copies, right? So what it means is that the useful life of this asset is now the production unit, not necessarily the number of years now, because somebody can produce can actually produce the entire 20,000 copies in one day. Another person might need to do that in 50 days, right? So useful life will not make sense then. It will then make sense to use the production units of the assets. Okay. So let's talk about initial recognition. Now, initial recognition says at the first instance, how do we recognize the cost of an item or property, plant, and equipment? So at the first instance, we're going to recognize it at the cost of the asset. All right, and we of course explain what cost is, and what will be our what will be our yardstick to be able to know whether we should go ahead and put it in our books or not. We say if it is probable that future economic benefits associated to the item will flow to the entity, if we can. Probable means there's a high chance that this can actually bring forth economic benefit, and if the cost of the item can be measured reliably. All right, so if we can measure the cost reliably, and if there's a probability that the future economic benefit to be obtained will flow to the entity, then we say we can recognize the cost. The next question is, what makes up the cost of an asset? Because for the fact that something is written cost behind doesn't mean it's part of the cost of an asset. I remember because it's an item of property, plant, and equipment, everything that makes up the cost of that asset automatically gets to be capitalized. Remember, your property, plant, and equipment is under your statement of financial position or your balance sheet, and it's under your non-current asset. So for every time you include something as part of the cost of an asset, of an item of PPE, what you have done is you have capitalized it. You've made it, and rather than an expenses, you've made it a capital, an asset. You capitalize it. So what are those things that should be included as part of the cost of a property, plant, and equipment? So the purchase price, that is the price you pay, when you purchase the item, or the price you will pay, and this is less any form of discount that you might have been given. You go online on Temu, you see a product, you purchase it, that's the purchase price, right? And then Temu gives you discount, then you remove the discount from it and any form of rebate, so that the purchase price is without any form of discount. So it's going to be removed. So because you didn't pay this discount, you got a discount. So the real amount you pay is the amount that you actually paid without the discount. Then we also have import duties, non-refundable taxes. What do you see? You notice that these costs are things that are associated in even bringing the asset to bear. Without these costs, these assets cannot even be available for use, or will not necessarily be an asset to be used. Directly attributable costs. These are your delivery, installation, assembly, site preparation. These are to be capitalized. The cost of testing the asset before use. Now, this is tricky, right? So sometimes the organization would have to buy raw materials to be able to test an asset to be sure the asset is doing well. And the cost of doing that is the cost of buying those raw materials to be able to test, that cost is actually going to be capitalized, right? But then there is a clause that, however, maybe you spent 200,000 naira to buy ingredients to be able to test the asset. And then after testing the asset, you had produced and you realized that the ingredients were good and the asset could produce what you intended it for it to produce. And then you then sell part of the first product, you then sell. So the standard is what if that happens. So when you are including the cost of the asset, then you have to ensure that you only include the net sales proceeds of an item produced during testing. So if during testing, as much as it cost me 20,000 naira to test the asset, but the product from this testing period then sell, and then it brought in like 5,000 naira. That's the sales proceeds. So what it means is that Amount to be capitalized will be 20,000 minus 5,000 because you've gained 5,000, right? You're only going to capitalize just 15,000. Okay. Employee costs arising directly from the installation or construction of the assets. This should be capitalized. So employee costs arising to the arising from the installation, yes. As long as they're directly linked to the asset, it should be capitalized. Professional fees, that is architects, surveyors, engineers. Imagine you're constructing, the cost you have to pay to architects. They're also part of the cost of the asset. The present value of initial dismantle, this is present value. Initial dismantling, start restoration costs if there's an obligation to remove the asset at the end of its useful life. So if you have to remove the asset, so a certain item of plant that would mean that you might have to install, and that would mean you have to do something on the site. Just think of a transformer, being put in a community. That transformer, they had to make room for that transformer by putting in some by like digging the ground and all of that just to make sure that place is good. So the moment you want to remove the transformer, you might need to then restore that back to the original state. So that cost might be it's a future cost, but that's why we're looking for the present value of that cost, which will be part of the cost of the asset. Now the following costs should not be capitalized. So when you see them, you avoid them. The cost of opening a new facility, no. Cost of introducing a new product, no. Cost of conducting business in a new location, no. General admin overhead cost, no. Startup pre-opening cost, no. So the question is, where do the costs go? You expense them. That means these are normal costs that should be expensed and not to be included as part of the cost of the asset. Training costs for staff, advertising and promotional expenses, costs incurred after the asset is available for use, that is, the asset is, imagine you're constructing a building and you are done constructing the building can then be used for business or for administrative purpose or for production purpose, and for some reason you didn't use it, and then you start incurring cost. That cost should not be capitalized because the asset had been available for use maybe 3 months ago. So you incurring costs after the asset has been available for use will not be taken as part of the cost of an asset. Routine maintenance and repairs, that should be expensed, not capitalized. Cost incurred while an item is operated at less than full capacity. Yes. So if it's operating less than full capacity, that cost should not be capitalized. Initial operating loss incurred while demand for the item output builds up. It is not capitalized. This will be expensed. Cost of relocating or reorganizing part or all of an entity's operation should not be capitalized. So if you get a question and all of these things are included, what you want to be sure that all the ones that are meant to be expended, you have to indicate that this should be expended in the P or L account. Okay, so let's go. So a company has purchased, an example, a large item of plants. The following costs were incurred. It has a list price. It has all of these. Then additional information says the test run cost was to ensure that the asset was installed and working correctly. Items of inventory were produced during the test run. These are the sales value of 10,000 naira. Local government officials have granted the company a license to operate the asset on the condition that the company will remove the asset and return the asset to return its site to its former condition at the end of the asset's life. The company has recognized a liability of 250,000 in respect of the expected clearance cost. Okay, so let's see what costs should be capitalized and what costs should not be capitalized. So let's see, and we'll try and do something. Okay, the list price of the machine, should it be? Yes, it should be. Okay, so this passes. The trade discount given. Okay, so that means there was a trade discount given of 50,000. So that means this should then be removed from the cost of the asset because we is less trade discount or rebate. Okay. Then we have delivery cost. Delivery cost, yes, because cost of delivering the assets should be capitalized. So installation cost, yes. Cost of site preparation, yes, because these are costs associated to the asset. Architect fees, yes, that's the professional fees. Um, administration expense, no, you don't include that. Test run costs, yes. Then we're told that that same test run cost, we were able to produce inventory from it, and then we say that test run cost has a sale value of 10,000. So that means the cost will then reduce by that. So this 7.5 will reduce by 10,000. So if you want to continue the way we've been, I'll just put 100,000. So this is it. This cost for this 125,000, 200,000, 15,000, 100, yes, 200,000. I've gotten that already. 15,000. Okay. So this one will now be 65,000. So it says that local government officials have granted the company a license to operate the asset on a condition that the company remove the asset and return the site to its former condition at the end of the asset life. The company has recognized a liability of 250 in respect of the expected clearance cost. Okay, so that means the cost of the commissioning or removal and installation is now 250. So that is also part of the cost of an asset, right? So installation and removal cost, or let me say removal cost, that cost is also part, and that is 250,000. Okay, yeah, that's it. You add everything together, and then you have 1,705,000 as the cost of this item of plant. Okay, so let's take another example. It says that a company buys machine on the 1st of January 27. The term of the purchase is that the company will pay 5 million naira for the machine on the 31st of December 28, 1 year later. An appropriate discount rate is 6%. Show this entry in the books. Now, if you notice that the asset was bought 1st of January, but the payment will be coming a year after, which is 31st of December 28. So how do we show it in the books? Do we show it at the books at 5 million, right? So the standard says, well, you're going to, because this is a clear indication of when you have to when you have to when you have an obligation, right? Because we've bought the machine already, so we just have an obligation to pay in a future date. So what we do is we have to find the present value of the amount so that we know that in our books we're recording it at the current present value. That is the equivalent of that 5 million in today's price. Okay, so let me show you. So we know how we do our 1 plus r minus 1. That's our present value. So you multiply this. So for us is 1 plus 0.06 raised to power minus 1 times 5 million. So if you do that, that's 4,716,981. So this is what will be in that will be shown in the cost of the asset. So what do we do? We debit PPE because now we have a new PPE. Then you credit liability because you have a liability 4,716,981 and 471 because we're paying at a future date. Okay, so but of course we know it's 5 million, but how do we then adjust for this at the end of the period? So at the end of 2017, what we do is we say, okay, well, the PV of the future amount is 47, so multiply by 6%, that gives us the discounting effect. So basically it's this difference that make it is the difference that makes up the 5,000. So you can also say 5 million minus this. That will give you this, right? So remember that 6% is the interest rate. So you want to also just multiply, because sometimes you could have multiple years, 3 or 4, 5 years. So you can't just say 5 million minus 47, because if there are numerous years, you can't just say that. So you have to say 6% of that amount. That becomes the discount rounding, and then you debit the P&L account, credit your liability, and of course you then show how this will show in the banks, because in the bank it's still 5 million you'll be paying. So when you pay, so it's still 5 million. So but the addition of this then shows that after all, the discounted amount means that as we move to the next year, the amount will then be 5 million, right? Because next year discounted against next year is still 5 million. Okay. So let's move on. Measurement after initial recognition. So after the first measurement or initial recognition, what do we do next? In subsequent years, year 2, year 3, year 4, what do we do? So we have a choice. We could either use a cost model or we use a revaluation model. Now, if you choose to use the cost model, so what it means is that we have to determine the cost of an asset less the accumulated depreciation and accumulated impairment. Now, if we're going to be using the revaluation model, so what we do is if we're going to be carrying a revalued amount, the fair value of the date of valuation less any subsequent accumulated depreciation and any accumulated impairment loss, right? So in this case, we're now checking for revaluation, and the moment we bring in revaluation, then fair value might be needed, right? To be able to know what the real asset is. Like the example I gave before, you do not want to carry an asset higher than the worth in your books. Okay. So what should we do when it comes to measurement after the initial recognition? Make sure the choice you choose should be applied consistently. A business cannot carry one item of PPE at cost and revalue a similar item. So if you're going to be carrying PPE in a class of an asset or property, you have to use the same cost model or fair value. You can't change them. However, business can use different models for different classes of property, plant, and equipment. But in the class, you have to use um, either the valuation model, right? So it means that you have to be consistent. So you can't use today cost tomorrow. You have to choose one and then use it for all the asset class. Okay. So let's talk about the accounting entries. So how do we record when there's a revaluation? Now, when there's a revaluation, that is, we revalue the asset, it depends on your results. So at the point of revaluation, if you check that the amount of the asset had increased, right? The value of the asset had increased. So what it means is that you would have to debit the asset. Remember that an asset is a debit account. Anything that comes in an asset account is debited. Anything that leaves is credited. So we have more asset now, because when there's a revaluation, it means the value of an asset has increased. So that's why we're debiting it. And then you credit the other comprehensive income. But on the reverse, when there's a loss on disposal, loss on valuation, you then debit only to the maximum of what you have ever credited. So what we're saying is, in the last year, there was a gain of 20. In the current year, there's a loss of 10, right? So remember that you had already you've shown a gain of 20. So you would go back, right, and debit up to the maximum. But our own maximum is actually more than what we have. So minus 10. But imagine this was 50. It means that you have to maximum, which is 20, you have to debit OCI to the maximum of the original gain, and then whatever is left not yet, which is 30, you come to the income statement and dump it. While the non-current asset, we put in everything, which is 50. All right. So that's what we do: loss and gain in revaluation. So let's take an example. An asset was measured at initial recognition for 100 naira. It is valued at these different price amounts. Show asset revaluation in the books. So how do we show how this asset will be valued in 2013, 14, 15, 16? That's what we're about to do. So let me get to the work notes so that it will be easier. All right. So let's go with what we have. So what do we do? So we have 2013. So you want to start with the dates. 31st of December 2013. How will these assets appear in our books? So when we got the assets, initial recognition we measured at 100. But now at 2013, the asset has increased, or the value of the asset it has improved, right? So there's a revaluation upwards. So from 100, it's now 130. So the rule is clear. Whenever there is a gain on revaluation, the asset account is debited, then you credit the OCI. But when there's a loss, so you can see that the loss now means IFRS then wants to really record a loss, wants to write off a loss. Because anything you put in OCI is not, you can't compare that with what you put in your profit or loss account. The OCI is the other comprehensive income. Or your profit and loss account is like a major account, right? So it says the loss should go to profit and loss account, but again should never go to profit and loss account except if it's an offset one. Okay, so let's see this one. So we have 100 and then now we're 130. It means that my accounting entry will say debit the asset account, whatever the name of the asset is, which is land, with 30, and then you credit the OCI because it's a gain. So OCI gets the gain. So that way we finish and we balance, right? Now, at 31st December 2014, we're now at 130. Then we got into the next year and we realized that we're now at 110. Wow. So what are we going to do? So that means the value has dropped again, right? Before it was 130, now it is 110. So there's a valuation of 20. Is it upward or downward? Of course, it is a downward revaluation. And when it is downward revaluation, what it means is that the land will be credited, right? And you would say, well, if there is a downward revaluation, let us go ahead and debit the profit or loss account. Isn't what we said in the format? Yes, but because there was a gain previously, so you cannot then begin to write off a loss in the profit or loss account. So there was a gain before. Go offset this loss from that gain that you have kept in the OCI. Use that gain to offset part of the loss that you have made now. Right. So to offset that, what it means is that OCI would now be, because OCI was credited before. So in the books OCI, there's a 13 error there. So OCI will now be debited. The moment OCI is debited, the question is how much is the difference? 20, because we moved from 130 to 110. So it's just 20. So you put it. So then the assets, which is you credit the assets. The asset has lost value because now it has reduced in value. So you credit it with 20. So the fall in value reverses the previously recognized surplus. Any previous recognized gain is now going to be used to offset a new law. All right. It is recognized in OCI to the extent that it is covered by the surplus. Then in 2015 now, 31st of December 2015, what we noticed is that on that day, the value of the asset dropped again from, remember it was 130 to 110, now 95. So that means we have the difference between 110 and 105 is 15. All right. So the question is, what do we debit, what do we credit? Okay. Now, if there is a further devaluation or downward revaluation, remember that we had not even finished expending the previous revaluation surplus. We had a surplus of 130, and which we wrote up, which we put in a surplus of 130, which we put in our OCI. The moment we had a loss in valuation, we wrote it off OCI. So OCI still has 10. It was 30 before, now we wrote off 20. OCI still has 10. Right? So if OCI has 10, what it means is that you have to take that 10 first, okay, to OCI. So you debit OCI with 10. All right, but there's still 5 left. Remember that the devaluation happened it was 15. So there's still a 5 left. So that means then you do what we do normally, which is for every loss in valuation, you take it to the profit or loss account, which is your income. So you credit your income statement with the 5, right? That the remainder. And of course, your land, which is the asset, which is credited, the entire 15 goes into the books of the land. So that's how it is done. Then in 2016, we then experienced, all right, so in 2016, we then experienced a gain from 95 to 116. You look at that, that's 21. Okay, so if there is a gain, what do? We debit the land for the gain of 21, and then we credit it depends. Now let's look at what we have is a gain, right? So, but we had a loss last year, and that loss made us debit our income statement. So we have to reverse that by knocking out that amount in our income statement, right? So we're going to have income, it's going to be on the credit side because it was debited before, it's going to be credited income statement. Okay. And then you're going to have you credit OCI, and that gives you 16. All right. So when you look at that, OCI is showing that there was a gain, right? So 21 year, 21 year. So that's simple what that is about. Okay. So we are done with that part. So let's move on to the next. Back to the slides. So now we then have so many cases that can be in PPE, and that's what we'll be choosing one after the other. So the first one we're looking at is the exchange transaction. And I've mildly mentioned this before. So can I buy a PPE by exchange? Yes. Could it be that this PPE came just because I exchanged something in lieu of that? So an asset may be acquired in exchange for another asset, yes. However, the cost of such asset is measured at its fair value unless the exchange transaction lacks commercial substance. The fair value of neither the asset received nor the asset given up is reliably measured. So we say, well, when there is an exchange, we actually use the cost of the asset and we use the fair value of the asset. But when that cannot be determined, maybe because it lacks commercial substance, then the fair value, if it lacks commercial substance, the fair value of neither the asset received nor the asset given up is reliably measured. So but naturally, normally we're going to be using cost of the asset. So, but depending on the method we're using, if you're using the revaluation method, of course, you're going to be valuing the fair value of the asset that was given up. Please, it has to be the one given up. So if the asset I'm giving up, so I'm giving up a 2014 car to get a 2024 car, the cost of the asset I'm giving up, right? The cost of the asset I'm giving up is 1 million. That would then be the cost of the assets. All right. So the fair value of the asset given up is used to measure the cost of the asset received. So for this asset I received, this new 2024 car, the cost of that new 2024 car will be the cost, the fair value of the 2014 car, unless the fair value of the asset received is more evident and clearly evident. However, if it's the cost model, you measure at the carrying amount of the assets given in exchange for it. So it's still the assets that was given up we're going to be using as our basis of measurement. Okay, so please know that additional costs. Can we have additional costs even when our property plant and equipment has been recorded in initial recognition? Can we have additional costs? Yes. Additional costs are costs that you might want to spend in addition to make that PPE, be able to function properly. So once an item of PPE has been recognized and recapitalized in financial statement, a company may incur further costs on the asset. In the future, subsequent costs should be capitalized only if it can be measured reliably and if future economic benefits will flow into the entity by the use of the asset. That's when it should be recognized in the books. All right. So more specifically, expenditure is capitalized if it improves the asset. For example, enhance its performance or useful life, extend its useful life, is for a replacement part, provided that the part that is replaced is treated as an item that has been disposed of. Okay, so notes. Repairs and maintenance expenditure is revenue expenditure. It is recognized as an expense as it's incurred. Please, no additional future economic benefit would arise from such. It's just giving us like more clarification, because we said for you to qualify as an additional cost, it has to be, it must meet the fact that the future economic benefit will come into the business, can measure reliably. All right, so that's for additional cost. Okay, so now let's talk about major inspection. Now, this is about regulatory expectations, right? If a company might only be allowed to operate some assets if those assets are subject to regular major updates or inspection for faults. The cost of such major operation is recognized in the carrying amount of the asset as a replacement if the recognition criteria are satisfied. Okay, when a major inspection is carried out, any remaining carrying amount of the cost of the previous inspection is recognized. So we're going to take, I think we'll just take the example rather than just explaining. Let me just take an example. So we have this example. It says there's a major overhaul. A shipping company is required to put its ship into a dry dock every 3 years for an overhaul at a cost of 3 million naira. The ships have a useful life of 20 years. A ship is purchased from a shipbuilder at a cost of 20 million. So initial recognition, what do we do? When we bought the ship, when we bought the ship, it was 3 million naira. Okay, so 3 million is the asset cost and should be treated as a separate component and depreciated over how many years? 3 years. Because the asset has 20 years useful life, but it has to put the ship into dry dock every 3 years. So that means 3 years at the third year, you have to do that. So the cost initial recognition recognizes the 3 million, but subsequent recognition would then say if the assets will have to be even though useful life is 20 years, but after every 3 years, we're going to do a major overhaul. So that means that the 200,000, no, the 200 million, let me get my calculator. Okay, so good. So the 3 million is the major overall. Remember that this is speaking to major inspection, right? So then we bought a new one at a cost of 2 million naira. But the law says, well, you have to write off the old one, because now that you have a new one, the carrying amount of the old one is still somewhere in the business, so you have to write it off. So to do that, what it means is that if the new would cost 200 million, so removing the um old one, the carrying amount of the old one, which is 3 million, so we're left with 197 million, and this is what we're going to be depreciating over the useful life of the asset. Okay, so let's talk about derecognition. At what point do you recognize an item or property, plant, and equipment? What does that even mean? It means, well, when we remove it from our books, remove it from the statement of financial position, that is the recognition. And what makes us do that? When the asset is disposed of, we sell off the asset, or when the future economic benefit are expected from it. When we don't expect any form of future economic benefit from the asset, so we just derecognize. So gain or loss arising on the recognition of an asset, item or PPA should be included in the profit or loss when the item is derecognized. So if you make any form of, remember there's a gain or loss on it. So carrying amount of an asset is 200 and you've taken depreciation up to the tune of 150. So the carrying amount now after the committed depreciation over the period is 50. Okay, so that's the new carrying amount. And then you sell the asset for 60,000. Is there a gain or a loss? There is a gain, because the current amount of the asset is 500,000, but you then sold it for 60,000. That means there's a gain, 10,000 naira. Okay, so let's take an example. Let's take this example. Okay, it says a non-current asset was purchased Just a minute. Good. Okay, it says a non-current asset was purchased on the 1st of June, year one. Okay, I see a lot of numbers there. So let's get to the work notes. So you view the question. Let's get to the work notes to solve this. Right. It says a non-current asset was purchased on the 1st of June. So you want to write 1st of June, year one. Costs is 216,000. It is expected its expected life was 8 years and its expected residual value was 24,000. The asset is depreciated by the straight line method. The financial year is from 1st of January to 31st of December. The asset was sold on, wow. Okay, so I've omitted something. Residual value useful life. Okay. Okay, so the asset was sold. So this is a case of disposal, right? The recognition has to happen. It was sold when? The 1st of September, year four. Wow. It was sold for 163,000. And the cost of disposal was 1,000. So it says that if the company, it is the company's policy to charge a proportionate amount of depreciation in the year of acquisition and the year of disposal in accordance with number of months for which the asset was held. What's the gain or loss? Okay, pretty simple. How do we determine the gain? So we need to be very careful because the date, if you look at the date, and the financial year of the business is from when? 1st of January. Financial year of the business is from 1st of January to 31st of December. Aha. So you can see that the dates has to align. So if we bought an asset when? On the 1st of June, year one, it means that by 31st of December that same year, we expect to close our books, right? So we have to close our books in year one, 31st of December, um, year one. We have to close our books. So the question is, how long has this asset been with us so that we can depreciate in line with the number of time it had been with us? This asset was bought 1st of June. Our close year, we're closing our books at the 31st of December. It means this asset had been with us all through June because it's 1st of June, so I'm going to count June. All through June, all through July. Okay, let me write it in a way that I know. All through June, all through July, August, September, October, November. December is part of it because it's 31st of December. So literally 7 months. So this asset had been with us for 7 months before the end of the year. So we need to depreciate the asset for that 7 months. Right? Depreciation has to be calculated for the 7 months so that you can have the carrying amount of the asset. So how do we calculate that? So what we do is, okay, so what we do is, since we have 7 months, we say first, let's determine the depreciation of this asset. Okay, so determination of depreciation, cost minus residual value over useful life. So the cost of this asset is 216,000. The residual value is 24, and the number of years is 8 years. So let's see. So if you look at it, it's a 216 minus 24 divided by 8. That's 24,000 per year. That's depreciation. Every year you should depreciate by 24,000. Okay? Every Yes, for the entire 8 years. Year one, 24,000. Year two, 24,000. Year three, 24,000. So what do we do if we have to depreciate this for 8 years at 24,000? And the first 7 months, we need to first of all close our books. So we will need just 7 out of 12 months of this 24,000. Okay. So what do we do? So we say 7 over 12, because there are 12 months in a year. And we're stopping at 7 months because we're going to close our books December 31st times 24, because we don't need the entire 24,000. So what it means is that 14,000 becomes the depreciation for that year. And remember, we sold in year, when did we sell? We sold in year 4. Okay, so but before we get to sell in year 4, we need to keep charging depreciation and keep determining the carrying amount of the asset, so that when we sell in year 4, we will then have to compare the carrying amount of the asset we've been carrying all this while and look at the amount we sold the asset, and then we know whether it's a gain or a loss on disposal. Okay, so let's move. So we've done for 7 months. So we're literally, this year is the end of the year 1. So we're going to be starting year 2, right? So year 2 says 31st December year 2, or 31st January year 2, right? But what I want you to understand is that there's no point in having January and then having December. From year 1, and a complete 1 year will end 31st December year 2. Okay, so let's determine the depreciation at the end of the year, isn't it? So that we know how much goes for depreciation. So for year 2, the amount of depreciation is 24,000 per year, isn't it? We've calculated that. So if it's just 1 year, that means depreciation is just 24,000. Okay, that's for year 2. Then we'll have 31st December, because from that year 2, we then move to year 3. All right, so 31st December year 3. Now 31st December, let me write it here. Year 3 is a complete 12 months. So what do we do? Still 24,000 will be here. So our depreciation is already getting clearer, right? Okay, but we sold in the 4th year. So the question is, when did we sell? Did we sell at the beginning? Nope. We sold on the 1st of September in the 1st year. So if you're going to be selling on the 4th year at the 1st of September, that means we held it in January, we held it in February, March, April, May, June, July, August, September, because we sold at the 3rd. Okay, it's the 1st, so September is not included. So we end at the month 8. Okay, so that means we held it in January, February, March, April, May, June, July, August. Then we would have done September, which would have been the 9th, but September 1st, so it's August 31st, we'll have to stop. And there are 8 months in there. So we're going to calculate that 8th month, which is 8 over 12 times 24,000. So 8 over 12 times 24,000 is 16,000. So the total depreciation, right? So we can see all the total depreciation. So let's quickly even calculate that. So we have 14,000 plus 24 plus 24 plus 16. That's 78,000 for total depreciation. Now, the cost of the assets is how much? So that we can tell the carrying amount. So let's say carrying amount. Okay. We need to know the carrying amount before we dispose the asset. So we have the assets costing 216. Then depreciation, all the depreciation, accumulated depreciation over the years is 78,000. Right? So if that is the case, that means the carrying amount is 216 minus 78, right? So that's 138,000. So this is the carrying amount. At the point of disposal, we're carrying this asset for 138,000. So how much did we dispose the asset? So we disposed the asset, sale of assets, we disposed it at 163,000, but we had, so we could say we disposed at 163,000, but we had incurred 8,000 naira in the process of selling. So that's why we're saying less disposal costs, right? So that's 162,000. So an asset worth 138,000, and then we sell that asset 162. Is that a gain or a loss? That's a gain. It's sold at a gain, and that gain is 24,000. Gain on disposal. Okay, yeah, that's it. So let's go to the next component. We're done with that part. Let's go to slides. So we're done with this, done with this. So let's get to depreciation. Yes, we're going to be dealing with depreciation. We need to understand what to do. So depreciation is a method, of course, which is spreading the cost of the non-current asset over its useful life. All of that, you can read that. I believe you just put there so you can understand it. Depreciation is charged as an expense in the statement of profit or loss. However, if depreciation relates to an asset being used in constructing another asset, in this case, depreciation is capitalized as part of the cost of the other assets in accordance to the relevant standard. So, if depreciation if depreciation is related to the cost of another asset, right? Then we capitalize. So we'll see examples anyway. But for now, just understand that depreciation will be capitalized only the only time it will ever be capitalized is if it's part of the cost of other assets in line with the standard that says so, right? That's it. But generally, you will expense your depreciation. So let's understand some of these methods. So we could either have the straight line methods, and if you want to calculate depreciation, if you're given a rate, you multiply the rate by the cost of the asset, and that gives you your depreciation. But if you're going to be using the reducing balance method, rather than saying times the cost of the asset, it will be times the carrying amount of the asset. So it will reduce imbalance. And the third one, for the straight line, it could either be percentage on a cost or its cost minus residual value by useful life, right? Reducing balance is percentage on the carrying amount of the asset. While depreciation is depreciation by number of the units sold, right? So for instance, if you have total number of, if what your depreciation is total production life or hours spent, so it's not like you can use straight line reducing balance. So we use this method where we find the number of units used and divided by total expected production over the life of the asset, and then we multiply by the cost minus residual value. Okay, we're going to see an example there, but let's just go through this. So we have that at times when your rates might not be given, but can you find it? Yes, you can. So as long as you use this formula where residual value divided by cost, then minus 1, then of course the square root, and then divided by cost. So once you're able to do that, that will help to know the percentage in case you're not given the percentage. The next one we're looking at is component depreciation. All right. So this one impacts on if an asset comprises two or more major components with different economic lives. Each component should be accounted for separately for depreciation purpose and depreciated over its own useful economic life. So if you have different components that makes up a whole and they have different useful life, right? So it doesn't make sense to lump them together and depreciate them. So you depreciate them according to the useful life. So if you take this example, the entire asset is actually 5.5 and it's a Gulfstream jet. However, the component part says the engine will last for 3 years, airframe for 10 years, fuselage for 20 years, and fittings for 5 years. So you've kind of, you have to then depreciate them one by one. So if you're going to do this, you say for engine, it will be 2,000 divided by 3. So that means it will be 66.67. Okay. So that is when I'm putting the percentage. Just cut. Let me do it properly. Okay. All right. Okay, so this will be the depreciation. Then you keep doing the same thing for the next. That's how to do for components. So you don't just say the 5.5 million. No, you depreciate each of the components. Okay, so when do we start depreciating and when do we even stop depreciating? All right, so when the asset is available to be used, you start depreciating, whether the business is using the asset or not. As long as the asset is ready, all things done, and it's available to be used, then you start depreciating. Asset is in the location and condition necessary for operating in the manner intended by management. But when do you stop depreciation? When either of these two happen, when an asset is classified as held for sale, and when it is derecognized. So that is when you will see, because when you recognize an asset for held for sale, right, it means the asset is no longer in use. So depreciation has to stop. All right. Or when the asset is recognized, does not bring in economic value again, depreciation stops. That's what we mean by that. So, however, depreciation does not cease when an asset becomes idle or is withdrawn or retired from active use. Okay, let's talk about another one before, which is reviewing the useful life of an asset. What is there any room to review the useful life of an asset? Yes, we talked about it under IS 8 when we're talking about estimates, and you can review the useful life of an asset. So it requires useful life and residual value to be reviewed at every year. And for us to do that, it means certain changes will have to happen, the carrying amount to be affected. So, and they will have to be decided. We're just starting all over again using the new information. So let's take an example. It says Benin City Engineering owned a machine which originally cost 60,000. On the 1st of January 2023, the machine has been depreciated over its useful life of 10 years on a straight line basis and has no residual value. On 31st December 26, Benin City Engineering revised the total useful life for the machine to 8 years, down from the previous 10. Required, calculate the depreciation charge for 2020, 26 and subsequent years. So let's see how this plays out. Okay, so I think it's better we use our work notes for this. All right. So the useful life can change. The residual value can change. So when it does, this is what we do. So before the chain, we want to know the carrying amount of the asset. If Benin Engineering owned machine which cost 60,000 on 1st of January 23, and then the machine has been depreciated over a useful life on a straight line basis has no residual value. So let's see the depreciation, right? Indeed. So let's determine depreciation. Okay. So we want to find the depreciation now. Let's calculate it like this. Minus. What's the residual value? No residual value. Over useful life. 10 years. So that's 6,000 per year. So every year we depreciate 6,000. Okay. What year did we have a revision? We had a revision on the 31st of December 31st of December 26. So literally means that we've used the asset for many years before we revise the valuation. We bought it in 23, we've used it for 24, 25, and 26. So that's 3 years before we eventually sold. So we know the depreciation. So let's say the cost of the assets is 60,000. Now depreciation, how many period have we used the asset? Remember that it says that we bought it in 21st January 20x3. Okay, and then revision happened 31st December 26. So how many years have we done? So from 23 to 24 is 1 year. 24 to 25 is 2 years. 25 to 26 is 3 years. Okay, so we've done 3 years. Okay, so that means the position is 6,000 times 3, which is 18,000. Okay, so what's left is 42,000. So this becomes the carrying amount at the end of 2025. Oh, we're not done. There's now a revision, right? Revision says that the remaining useful life is now 8 years rather than 10. Okay, so that means we need to adjust, because if useful life change, it means that this estimation of 6,000 per year is not true any longer. So we need to adjust for that. So we need to know, where are we now? It's literally asking yourself, what's the cost of the assets now? Okay, what's the cost of the asset now? The cost of the asset now is 42,000. Okay, if the cost of the asset is 42,000, we then need to depreciate it with how many years? Now remember that before it was 10 years, now it's now 8 years. It has been reviewed to 8 years. So if we've reviewed to 8 years, right, it means that prior to this review, we had done 3 years of depreciation, right? So it means we only have 5 years more to go, right? So that means the useful life is 5. If from 10 we move to 8 and we've done 2, remaining 5. I'm sorry, we've done 3, remaining 5. So that's how we have useful life of 5 years. So if you divide that by 5, you have 8,400 per, you know, for the each of the depreciation per year in the future years. That's it. So let's take an examination question together. So this one says Noodles Nigerian Limited. So I have questions in here from FR and SBRL, and this is intentional to give us that range of complexity. So we move from less complex to more complex, so that we're used to, and we understand this thing better, regardless of whether we've done it before or not. So Nigerian Noodles or Noodles Nigerian Limited manufacture various types of noodles Oluyole in Oluyole for sale across the states in Nigeria. Recently, to continue a sustained leadership of the company in the Nigerian market, on September 1st, 2015, a brand new machine was bought from a supplier under the following conditions. So we have all of this, and then we have all of this information regarding to the useful life of the asset. Okay, so the question is, how do I determine the asset? What is the cost of this asset? So we need to screen through this list and then ensure we include only what should be as part of the cost of an asset. So we'll go into our work notes and then we'll begin to exclude and then we'll come up with one. All right. So Let's begin to screen them one by one and see what should be part and what shouldn't be part. So we'll go to the first one. The first one says supplier's invoice. All right, should that be part of the cost of the asset? Supplier's invoice. Yes, it should be part of that. So you want to put in there supplier's invoice. And how much is that? 500,000. Then we have trade discount of 25%. Wow. So that's 25% out of 500,000. We remove that sales discount. So the real supplier invoice should now be reading 500 minus 1, because 25% of 500 is 125. Okay, so if you want to confirm that, you can do that. Okay, so we go. So let's screen the one after the other. Discounts applicable on invoice price for early settlement is 5%. It says it's applicable for early settlement. We didn't even get information whether we settled it early or not. So we're going to be ignoring that. Freight and shipment cost, should it be capitalized? Are they related? Yes. To the construction, yes. So this should be capitalized. Then we have stevedore expenses. Is it part of the cost to be capitalized? Now, I know not every one of us might be familiar with the word stevedore, and the truth is, if you're not familiar with it, you may never know what it is. All right. So basically, the stevedore is still relating to the industry, the ship industry, still related to cost related to that asset. So we would still capitalize the as and the expense. Okay. Initial operating loss, should it be capitalized? No. So what do? You move it to revenue. Good. Or P&L account. Handling costs, should we capitalize the handling costs? Yes. Handling cost of the assets, yes. So then we have electrical and installation costs. Well, electrical and installation costs are also linked to the product. So because without it, you can't tell whether it's working. 25,000. Then we have interest on loan, to the point of usage. To the point of usage, so that is not to be capitalized at all. Interest on loan after, no, not to be capitalized. Pre-operational expenses, should it be capitalized? Nope, because these are expenses from the beginning of business opening and all. It should not. Start training the use of machine. Nope. That's recurrent expenses. What else do we have? Professional and consulting fee on advice to buy the machine. Well, we said professional fees are important. Okay, what else? Then purchase of a 4-year maintenance contract. Wow, that would be expensed. Production testing costs is 13,000. So testing cost is allowed. Pre-production testing cost is 13,000. Then estimated residual value, should it be capitalized? Obviously not, it shouldn't. So if you add all of this together, you should have 57800. Yes, 57800. So that is the cost. This is the cost of the machine. Okay. But furthermore, let's continue. We were given the useful life of the asset, meaning we're supposed to calculate depreciation to know the amount of depreciation per year. Okay, so for us to be able to do that, because now we have our carrying amount for the year 2015, we need to be able to charge depreciation for that same year 2015. So how do we determine depreciation? Do we calculate depreciation? Obviously, straight line won't help here. Reducing balance won't help. We'll have to use the total expected production outputs, right? So, and it says you have to say the cost of the asset minus the residual value over useful life. But this time, no useful life. You see, this is production units. So we're going to say number of units over total expected production output. Okay, so let's find it. So for 578, let me shorten it. 578 is the cost, right? I need to know depreciation and the residual value rather. The residual value is 90. What is the number of units? In the first year, they did 1,000 units. Out of how many? If you add 1,000 plus 1, so plus 1, 4, plus 1, 8, it will give you, it will give you 4.4. However, it means that there's a year that was probably not included. We're told that the estimated useful life of the machine is 5 million. Wow, so we're going to be using that. So we're going to be picking proportion of that. All right, so that's divided by total expected unit is 5,000. So we took 1,000 out of that, and that will give us 97,600. So if this is the depreciation, so what will be the carrying amount at the end of the 31st of August 2016? Remember that this was the carrying amount at, or this is the cost of the machine at September 2015. So by the end of the year, which is 31st August 2016, right? We then say we have depreciation of 97. So that means the carrying amount by 31st August 2016 is 578 minus 578 is the cost minus the depreciation 97.6, which is 408,400. Okay, so we've been able to determine the carrying amount at the end of the first 2016. But let's see. We were told there was an upgrade that was made. We were also told that the useful life was adjusted. When did the upgrade come in? We said on the 1st of September 26th, at the beginning, right, of that year, we decided to do an upgrade and then added a new component, and that new component would result in increasing useful life, so we can then recognize it, because increasing useful life is bringing forth economic benefits and it's costing us 300,000, right? So what it means is that the upgrade then improves the carrying amount. So the upgrade is 300,000, improving the carrying amount, right? So it means now the new carrying amount is 780,000, 780,400. Okay. So this is our carrying amount of 31st August 2016 and 2017. Because well, it's still 2016. This was supposed to be it, but then we had an upgrade before we closed for the year, which is like we had the upgrade at the beginning of the year. So it's still within the period. So by the time we close the end, then we know that whether there's a depreciation. So for us to close the year, it means that we need to find depreciation, right? We need to be able to depreciate these assets for the year 2017. All right. So, but we're told that the upgrade happened and then the useful life was increased to 8,000 units, 8 million units. So if the useful life is increasing to 8 million units, it means depreciation will have to be calculated. We have to recalculate the depreciation. But to be able to do that, because now the question didn't even tell us how much units should go for different years as we had before. So we're not even sure how much unit, but we can think through it. If in previous year we had 1,121 for 800, and we're saying that the maximum useful life is 5 million, and now that we're improving that to 8 million, that means we can use the previous calculations or equivalent amount to then check for this period so that we can use that information to help. But in our current period, we really do not have the separation of the depreciation in terms of the units as of asset use. So we need to find out. Okay, so how do we do that? So the next thing is to determine depreciation. And if we're going to be using the total expected production hours or units, we need to know in 2017, right? So in 2017, how many? In 2017, because in 2016 we used 1,000, but we then change. In 2017, we need to know how many. Because in 2017, the old one says is 1,200, right? But if you've increased something to 8 million, it means that we need to take the fraction, right, of that and put it over the new amount and the fraction and then multiply by the new amount. So in 2018, because in 2017 rather, depreciation will now be 1,2 because we've done 1,000 in 2016. 2017 is 1,2. Now over what was the amount left, because now that we have scrapping that useful life, so we used to have 5 million, but we are taking 1 million out of that 5 million, so we have 4 million left. Okay, 1/2 over 4 million left times, so this times is to help us equate it with the units. Like imagine you want to convert 10 over, somebody gets 2 over 15, 2 over 10 in exam and you want to convert it to 15. What do? You say 2 over 10 times 15. That's what you do. So I want to convert 1,200 over 4,000 to 8,000. So I'm going to say 1,200 divided by 4,000 times 8,000. That's just math. No big deal. That's just math. So if you multiply that, you notice that the unit used, because we need to find the unit used before we begin to even calculate depreciation. Unit used in 2017 is 2,004. Unit used in 2018 would be what? The unit for 2018, the old one says 1,4 over what was left, 4,000, right? Before we change. So we want to equivalent it to 8 million. And that's 2,400 units. 2,800 units. Then the unit used in 2019. So what do we have? We have 800 units divided by 4,000 units times 8,000 is 1,600 units. Okay. For 2020, to know the number of units, we don't know because we don't have it because the previous one never had it. So are we going to stop in 2019 because we don't have it? No. If you look at what we've done so far, let's see how many units is left. Out of these 8,000 units, we've taken 242816. What is left? So your 8 million minus 24. So in 2020, it will be 8 million minus 24 minus 28 minus 16. Okay. So if you do that, what you find is you get 1,200 units. Okay. So now that you have the unit, it's now easier to calculate depreciation. So let's go back and calculate our depreciation. Remember where we stopped was in 2016. So let's go calculate depreciation for 2017. So all of these are just calculation for the unit. So for 2017, depreciation for 2017 would be cost minus residual value times number of units used divided by total expected number of units. All right. So what's the cost? Cost is always cost. All right. It doesn't. The cost is 78. What was the residual value? So there was a revision of residual value. And say as a result of the new upgrade, there was an increase in remaining useful life, yes. And then the residual value also was revised to 114,000. So minus 114,000. So the residual value has been revised. So we use the new one. Then 24, which is um number of units consumed in 2017 over 8,000 or 8 million, right? Okay. So or you just remove the zeros. You can also do this. Do this. So it means the depreciation would then be, remember that this was our carrying amount. So we can just bring it down so that it's not confusing, right? Can just bring the amount 78,400, which is carrying amounts as at 31st August 2016. Okay, so and this depreciation is 2017. So now that we have the amount, we can calculate that, which is 199,920. Okay, we take that away from the carrying amount, you have 580,400. Okay, that's the carrying amount now at 31st August 2017. So depreciation for 2018. Remember we've done 2017 already. But 2018 is still repeating the same thing. 780 for 780,400 minus 114,000. So if you can just remove it once so that you just be using it. So that will give me 666,400. Okay, so multiply by 8,000, number of total unit by what we consumed is 2,800. So in 2018, the depreciation is 233,240. So you take that from the cost of the asset. So what you have is 347,160. This becomes the carrying amount 31st of August 2018. Okay, so the next one is what? Depreciation for 2019. The same thing, 666,400 over 8,000 units times 1,600. So that will give me 133,280. Okay, if you take difference from there, 213,880. Okay, so the position for the next last time, which is 2020, this is carrying amounts. That will be 664. Sorry, 666 times 16. Oh wait, for 2020, it's 12. Don't want 6 already. It's 12. Okay. You multiply that together, you have 99,960. Take that away from that, you have 113,920, which is the carrying amount 31st August 2020. Okay, so that is clear. So the next thing is we've sorted that. Oh, the expense that we couldn't capitalize, sorry, the costs that were not capitalized because they did not fit definition would then have to be expensed. So we're going to have a revenue expenditure, schedule to be able to key in that in. So we need to understand that some of them occurred in multiple years. So we have 2016, 2017, 2018, and 2019. Or depreciation, for instance, because all of this will be revenue expenditure will be spent. So you have 97. I'm just speaking what we calculated. 1,1,233, 133. Okay, so we also have initial operating loss, which is not to be. We already said we are going to expense that. So what you can do, you can even be doing the two. When you read it and see that it doesn't fit into one, you can actually put it in the revenue expenditure. All right. So initial operating loss is 10,000. So you put it in as 10,000. Then interest on loan, we said it's not to be capitalized because it's not related. So we're going to treat borrowing costs now. If it's related to the loan used to construct the asset, yes, it is allowed to be capitalized, but this isn't, use loan to use it after using it. No, it doesn't work. It doesn't qualify. So we're going to treat borrowing costs and see how we capitalize that. Then we have pre-operational expenses. The pre-operational expenses is 5,000. Then we have staff training, which is an expense. And they all happened that year. That's why they all fell under 2016. Then we have the maintenance contract. If you notice that the maintenance contract says it's a 4-year maintenance contract. So that means the 120,000 is split in 4 years. 120,000 divided by 4 will give you 30,000 per year because it's going to be used for 4 years. So we're not going to record everything in 1 year. That's it. So let's calculate all our revenue expenditure. There's 212,600 This is 229920. This is 26324. And this is 163280. Yes, that's it. So that's exactly how you record that. So it's not too complex, but quite tricky, and we've been able to find justice to this question. So please take out time to go through the other questions that are included here. I've also included the answer. You can meet in with your accountability group, and you guys can just see how you can discuss about some of these things. That way you're learning. All right, so we'll see in our next class. Have a blessed time.